Okay, there we go. Thank you very much for joining. We'll give it a few minutes here. Pardon me. Give everyone a chance to arrive here as we get this going. We are 9 minutes, 69 minutes remaining in this options expiration Friday for September the 6th, 2024. Thank you very much for joining us. Give everyone a chance here, get this rolling, and hopefully this will work out just fine on this. Pardon me. As you can tell, I'm just getting back into the swing of our daily broadcast. It's been a couple of years since we did this, and I thought best to kick this off right now. Okay, let's take a look at this. As I said, we are just a little bit more than 1 hour remaining on the clock of this Options Expiration Friday. The happiest day of the week, Options Expiration Friday, for those who make use of my selling options theories, capturing volatility premium. It is our payday. And a few ups and downs. And remember, markets may go up, markets may go down. I know it's been a few years since you've heard this, but each week option premium will decay. And that's something I've been saying for near 40 years, 40 plus years. Many people seem to forget that. So remember that. Markets may go up, markets may go down, but each week auction premium will decay. But also, markets all revert to mean. And you've got a balance between understanding the fundamentals and certainly technicals, but also recognizing all markets do revert to mean. And that's an important point to make today. And one of the reasons why I decided to sign on and post this little message for posterity's sake. Yeah, it's been a long time since we spoke, and I think for many, it needs to be reminded. When I talk of this, of course, today, right now, people are astonished. But why? Of the market movement. Right now, as we speak, the market, the Dow is off some, we'll call it 1%, 435, with the NASDAQ leading the decline, off 2.5%. I want to remind you, tech has led the advance, and tech will lead the decline. NASDAQ is down some 2.5%, or 427.8 at this moment. With the S&P, we've all got the bingo chip down, whether or not it'll clear a 100-point haircut today. Right now it's off 95.07, 54.08, 54.08.49 at this very moment. And certainly from my standpoint is, again, this is why I called, I believe this market is deeply overvalued, and one has to be aware of this. VIX is spiking up. I would not be, there's you are. Great to see you here, my old friend. I would not be chasing NVIDIA at this time, and I do believe that markets, people will be punished completely for such. Now, we might see a response in the euphoric rise of the market, but hold on. The euphoric rise of the market, a rebound should the Fed react to the bullying, let's for a 50 basis point cut. But that is only part of the story, because once the Fed does start its climb, basically it's a starter's pistol or once the Fed starts its rate cuts, that is essentially a starter pistol for a deeper pullback of the market. So give that some thought here. But again, right now we have VIX spiking up, and that's really been the story of the day. What a remarkable spike on VIX, up 2.5%, 2.54%. I want to tell everyone, here's a little thing that everyone in my group learns. VIX is always reported incorrectly. VIX is a percentage. So suggesting, as most of the news sources, financial news sources will suggest today, VIX is up 12.6%. They're comparing the percentage to percentage. VIX is up 2.5%. Little sidebar comment there. So up 2.5% right now to 22.39. And of course, commodities really are telling us a story. The WTI is really, oil is telling us a story that a recession is looming. Another point I wanted to emphasize with everyone, a recession is coming. Now, first of all, when we started the nonsense of those COVID years and all the policy of the global buffoonery of that, and I was ceremoniously censored from all online, we were a late stage economy. We were ready for a pullback, and it would have been a healthy pullback in the market. See the S&P retraced to say ballpark 2,800-esque. But again, we've bloated this market. The money thrown at it, as I emphasized through that period, will never be returned. We will always be paying for this nonsense, and so be it. But right now, oil is telling us a recession is looming, a slowdown. I also think that iron ore futures in China is giving us good clue on that. But right now, we've got WTI backing up $1.29, 67.86. Look at the blood in the water of Oxy. Oxy is just bleeding. If we want to look at probably one of the big beatdowns of the day, and there are many. Oxy under $52, $51.91 at this very moment, off 3.4%, $1.83. What a situation that is. Oxy really bleeding it out heavy right now. So that's an interesting point to look at. So give thought that right now, what's happening in our energy pit is basically a message. A recession is coming. If a recession comes, and this is about 3 points I'm going to make regarding the general market, I want to emphasize to you when I look at forward earnings, there's a couple of things that strike mind. First of all, overall, and you'll see how I believe this market is prone to an extreme reversal. All markets revert to mean, and maybe I'll save the worst for last, give you the best news first. If a recession's coming and I look at forward earnings, I would suggest a pullback comfortably in it around the 3,500 range, the S&P. That's that's obviously quite the nosebleed when you think about the drop to 3,500 from 5,400-esque, and certainly in the recent moves of the S&P charging in the mid 5,600s on way. It looked like it was heading off to that 5,800, even as high as 6,000. Certainly that was in the realm of possibility, but around 3,500-esque should we have a recession. But that's not all. But however, that's what I want to remind you and allow you to take from this move in WTI. It's backing up and it's uncomfortable right now. And as we also look at this, and for the question that my good old friend mentioned, great to see you here. Wonderful. Thank you very much for joining. Great to see you. Hopefully we'll be able to talk again soon. As my friend mentioned here, old friend Jesse mentioned, as far as a question with regards to NVIDIA, I look at that quite honestly, and I don't think many people have considered, when you say AI to me, I say energy. What's going to fuel that? And I believe what's going to fuel energy in the future domestically is natty, natural gas. We'll talk about that at another time. But right now, I want to emphasize to you what's happening in the energy pit is saying recession. Recession is looming. This we know. We look at those jobs reports. I was very uncomfortable jobs reports for me today, looking at full-time jobs plummeting, part-time jobs accelerating. The gig economy, as much as it is a reality of the modern world, does not mean for a long-term success. It means we're all scrambling, right? So again, WTI right now backing up, call it $1.22. Well, natty is choppy contained in the normal natty section, up a little bit more than 1%, up 0.027 to 228.1. Now within metals, this is, first of all, you have to remember a few things, and a couple of points here I'm going to make here. And I promise you, I'm not going to spike the ball here. I don't. I hate spiking the ball, but there are a couple of things I do have to mention. First of all, I did not like the run of copper recently. If I had been public throughout the last few years, you would have heard from my group when copper made that extraordinary run this past year, when it made that move just after China returned from its holiday period, its Chinese New Year celebration, to basically the week before Memorial Day weekend. I was saying, mind the whipsaw. It's ready to have its lumber moment or cocoa moment or whatever it is. Mind the whipsaw. It's going to back up. Watch this as it backs up to south of 420, really into that $4 range, and we'll see where it shows support. And it showed enormous support at the 395 range. Very positive, but that recent run up to 420 ignored what was going on, say for instance the Chinese manufacturing economy, the Chinese manufacturing base, which is very troublesome right now, showing extreme weakness. And certainly, again, iron ore futures is telling us a great deal. But along came a lot of different things happened. And a company that I urged, and we'll go into this a little bit more greater depth, a company that I urged buying when it was approximately $4 on the big board, Hudbay Minerals, did a very interesting bought deal. And I thought it was an absolute bloat of a situation. Now, there was a lot of good things. We had urged buying HBM when it was $4. But when it ran up into May, we were a little more concerned of some of the things that went on, including a bought deal and a very strong issuance. I didn't like that at that time, and I said this equity was prone. Now, we closed our positions, we took good profits, and we were very pleased with our situation. Very pleased. But I'm not pleased with HBM after that issuance of in a very extensive dilution to partially fund their Copper World project. A great project in the Southwest United States, but again, I am concerned with it. So while I did not short HBM at that time, I do believe it was headed south, and we're looking on the acquisition trail for HBM, but not yet. Remember, if you've been part of my group for the past years, and certainly in the last few years as we went private, right now we're in a very good cash position and we're waiting as blood in the water. Remember, again, another little point, just as I mentioned to you, markets may go up, markets may down, each week option premium will decay. The money is made on the buy side. You were born swimming, good sharks that you are. You have to wait till there's blood in the water and then you attack. With HBM, not yet, not yet. We'll see if that opportunity presents itself, but we'll be patient, and that's why we have it. That's why in the run-up, say for instance, if FCX as it approached $55, we were going long $60 puts. We went long extensively, completely collar situation, wrote deep in the money calls, went long $60 out of the money puts, and really did tremendous with this move. It's a great conversation that I've had with my friend Anthony, that as much as you look at the year of FCX, and you say, well, the stock is unchanged. Well, in actual fact, we've doubled our money by using selling option theories and risk management tools. So again, let's go back to that. Copper is showing some extreme weakness right now, off 7 cents. But I think it's finding a nestling zone right now, 407. I'm going to watch whether or not copper backs off. Justin, great to hear from you. Hope all is well in Ohio. Beautiful Ohio. We'll be there in roughly a week, traveling through Ohio, I suspect. However, I'm waiting for copper, whether or not it shows some resiliency here, or we wait for a greater support at 395. But again, right now, 4071. And obviously, watching FCX, that's our principal player. I've been a long-term shareholder of FCX, and I will continue to be a long-term shareholder in FCX. Matter of fact, this past year, I doubled my position, very recently doubled my position in FCX. In a very broad strategy related to options and tax shields and whatnot, but I expanded my position, doubled it, as I said, and I've been a shareholder for approximately 15 years. And for those who remember the early stage, I was telling people to go hard into the paint and buy FCX when it was in single digits, and none greater than probably Greg. We have a lot of stories of that, buying it when it went sub 6 and even sub $5. FCX backing up right now, nearly 3.5%, $1.43 to 39.97, 39.97. I've been suggesting that everyone keep their rolls at around 38, 39, $8.50. Keep this really tight, absorb that option premium, absorb any of the anguish that the majority of the market is feeling right now. This is a comfortable period. It should be a comfortable look. We've got the cash. We're sitting at the table here. We don't have to buy until we see the right amount of blood in the water. And I have to remind everyone, not just yet. I believe very strongly in the assets of HBM, but I think right now we can get a better price. It's a very good asset. We have to invest. What's such a long question to answer here? I'll try to summarize it in the most appropriate way possible. If we don't invest in commodities, if we do not have an administration that invests in the domestic production of the key commodities, we are all turning our future over to another country, and most likely that being China. It's time for us to invest in commodities domestically. We have the assets are there. There's some extraordinary assets in the beautiful states of Arizona and California, as an example, as well as others. We have to invest in production there and do it in a way, and I believe that we can do it in a far more environmentally conscious manner than in other regions of the world. We also can't rely solely upon other regions of the world for key metals and minerals. Again, most of those regions, this is a long story to talk of. Places like Mexico and Peru are not going to roll over so easily for our domestic needs. We have to start investing appropriately. HBM's a company with some very good assets. I don't like what they've done with their recent issuance, and I do believe the stock price, and I have said this, is prone to an extensive correction. I have invested in this company periodically over the last, I would say, 5+ years, maybe even 10 years, done extremely well with it, and I'm going to wait for a better opportunity. And that's what I encourage investors right now. Wait for a better opportunity. We'll give you the go sign, okay? So FCX is backing up right now, just under $40, we'll call it. Keep your stops, keep your rolls very tight. In my opinion, for myself, I'm keeping them very close, 38, 38 and a half, 39, okay? At the very most, okay? But more on that a little bit later. Silver obviously feeling the anguish right now. Silver's prone to an enormous upside right now. And right now, silver's off 85-ish cents, 84.4 cents, 28.26, 83.9, pardon me. The odd thing about silver right now, and regardless of these ups and downs, you're not going to be purchasing bullion, silver bullion at a great premium, or without a premium per se. But silver is probably the best standalone investment one could make through the balance of this decade. The upside of silver is enormous. It's getting extremely, my pleasure, Jesse, it's getting very difficult to mine silver. Miners are having to go deeper underground, and it's not so simple. And the great producers of silver, Mexico, Peru, it's not going to be so easy to mine, and we're going to have better mining operations, more efficient mining operations that invest in the communities. Hats off to First Majestic for investing in their community in Mexico recently. They certainly have, it's been painful in their stock price recently. I applaud them on their recent acquisition of Gatos that was announced yesterday. It's a tough time to announce given and the market has punished it greatly with the all-share deal, but this is a tremendous asset base, and they are doing some great operations in the beautiful country of Mexico. So silver backing off right now, and if I look at the pain on the board on silver, it's extensive, and there are some just equally as extensive of opportunities on that. And looking across the board, obviously we've got First Majestic giving back 5% today, really fighting on those lows. We'll call it 462. Fortuna mining, and I have periodically slipped up and called it Fortuna Silver. I go back in the days, is really Fortuna Mining, and I would say it is arguably Fortuna Rocks Gold. That is a West African gold company, but still many will associate it to silver. Fortuna is off not quite 3% today, 12 cents 14. Great opportunity to acquire there, but again, we want to be patient here, and we're not going to do any buying right now on a Friday unless we're very confident of the option play. Where we've got some blood in the water is Hecla. HL, maybe the industry standard, and as far as tremendous mergers and acquisition department at Hecla, and obviously we all know its long history and its relationship with the institution. Hecla is a great situation, and many on our team, on our hunting party, have done quite well with Hecla in gradually building a position. And quite frankly, the buy rights, the simple buy rights using in the money calls with Hecla are just easy victories for the long-term investor. Another point I need to make, we're investors, not flipper. I want to remind you, post-it note this please, the best investments are the ones you never sell. Funny story, earlier today, my good friend JJ asked me about buying Barrick. Barrick brought me to the dance. Many of you only know me because due to my investment in Barrick starting in May of 1983, it made my financial future, and this punk kid who had no chance was given opportunity because of his investment in Barrick. But so again, I'm not the one to ask of it, but the best investments are the ones you cannot sell, or the ones you never sell. And right now, buy rights with Hecla, there's some very juicy opportunities there. We can discuss that more on Monday, or obviously in the balance of the week as we get ready to get on the road. But again, let's get back to the market. Now, gold, with the rest of the silver sector, pardon me, and obviously I'm just going down it's great to see you here. Thank you very much. We got to get you guys back on the group. Time is, but we'll be back. Great to see you here. Thank you very much. Mag Silver, great company, very good exposure to the silver sector, obviously. I think this is tremendously undervalued. Actually, when Keith asked recently of silver companies and takeovers, and the only one I could really think of is really Gatos and Mag. But Mag's one of my preference over Gatos. Mag's a great little company, bleeding off today. We'll call it a little bit more than 2.5%. Very good situation. Unfortunately, strategically, you have to be very patient. It only trades on monthly options, so we want to be able to be very careful here on that. But Mag's a great situation. Going down the line, PAAS giving back 3% approximately. As far as an asset base, PAAS, it's certainly worth the argument here. I think it's the best in the show, the best in the sector. It's got a great sector, great asset base, tremendous company. Off today, this is another great opportunity. But again, I'm going to emphasize, stay tactically sound, okay? Now, obviously, within gold sector, we're seeing a little bit of bleed off, and Barrick's doing the song and dance. We got the rally caps. Where's my cap here? Oh, there we go. We got the rally caps on. We're on down only 2% rally caps. It's not quite ready for the rally caps, but we've got our rally caps. Barrick is off 2%. A lot of blood in the water here in the sector, as is AEM. Just a great company, AEM, off 2%, but it's looking fine here, okay? Again, look at these, stay very tactically sound. When I say tactically sound, always use your buy rights when entering. No one can predict, contrary to what people like to suggest online, no one can predict the absolute top of the market or the bottom or the individual swings and arrows and ups and downs of the end, but when you of a particular equity. But when you use a buy right, when you use your covered calls at the money and constantly roll, you are constantly capturing theta, constantly capturing that volatility premium. We're going to be discussing that a great deal of length. I know it's a lot to absorb now, but we'll be talking about that in length. Remember, we capture volatility premium. It's a theory I came up with first as a student in nearly 44 years ago. I refined it obviously as I entered the industry and had time to postulate on it. From a young teen student to thinking about these things, understanding the mathematics of it. But that's what we were doing. We can dine very well on capturing volatility premium. In other words, it can fuel your financial life and provide you that peace of mind portfolio insurance. So what we're really seeing, let's summarize this, we're seeing a lot of blood in the water. Now, if I'm going to go through blood in the water, I've got to mention to you a few companies that I really like. Mostly within the uranium sector. You all know that I'm very bullish on uranium. And there's a lot of reasons to be bullish on uranium in the future. And I've been talking of uranium online since really approximately October 2017. I've been talking of copper, heck, since probably MySpace days. In the long game, copper is gold. But uranium, I mentioned, Cameco was a strong buy in October of 2017. Right now, this is problematic. And we've got a lot of different things going on. And I'm concerned of a further meltdown on uranium. Trading at this moment, Cameco is doing a good job fighting off the lows of the day. So it is rebounding to some degree. We're about the mid part of the day. Cameco dropped to a low, of 35.90. I was suggesting to my friend JJ today, we're talking of the 37.50 puts. No, not yet. And sure enough, it flowed down immeasurably. Right now, it's sitting at 36.84 on this. I'm concerned of a step down to Cameco in the coming period, because remember, September is an extremely volatile and uncomfortable period. Step down to the 30 and a possibility of 25. And do not ignore the fact that as we enter into this decade and through the nonsense of the COVIDian years, Cameco was in the single digits. We have to watch this. because all markets do revert to mean. So again, right now, 36.88. Again, I want to urge you, stay tight with your rolls. 45 minutes left on the clock. So now, let's go back to where we began this, and we're talking of the general market, because this is my real point that I wanted to emphasize with you. Right now, we've got a little bit of a rally cap. I showed the cap, the market went up. Don't explain it. That's a joke, but don't worry about it. But we're off 83-ish points right now in the S&P. All markets revert to mean. This is the tough news for people, particularly with the vast percentage of Americans with their retirement funds, their 401k plans, and index funds. It's alarming. This market is bloating beyond all belief. If we have a recession, as I noted, I can see an easy pullback into 3,500, easy. But right now, fundamentally, this market is, hold on, sit down, is no less than 2/3 overvalued. That's an astonishing fact. All markets revert to mean. Go out, just Google the Buffett indicator. Take a look at GDP to the Wilshire 5000, and you realize this market is extremely overbought. It's prone to an enormous correction. It's shocking how deep the depth of this market can pull back. Now, from a technical perspective, and I do not want to urge you to purely trade on technicals, this market has also some other issues to it. I've been saying for quite some time, I think there's a possibility this market can run from February. I was noting possibility to run to 5,800. Got within 2.5% of that, and which is basically ostensibly within my plus or minus range, good enough. And then we started to pull back. Now this leads to me to a deeper pullback. I'm looking at right now a reasonable probability in the interim of a pullback of the S&P to around 47.50 to 48.25, and a lesser probability to a pullback of 4,100. But if we get that recession, we got 3,600 on the docket. And we also have to be concerned of that fundamental base of reverting to the mean, which is, hold on, 2/3, are we really talking of a pullback to around the vicinity of 1650? It's an outright possibility. Now that's not going to happen overnight. Please, that's not it. We might have that decade, or the balance of the decade, of a death of 1,000 cuts, where everyone keeps thinking of buying the dip, and they can't find out, they keep finding a new low is coming, lower than lower than lower, and it's exhausting, okay? So we have to keep this in mind. So the points that I want to mention and why I called you, and I'm sorry I've taken the half hour of your time, as you go into this weekend, you still have time. You have 42 minutes left on the clock. That's right, 42, pardon these old eyes, 42 minutes left on the clock. Manage risk before risk manages you. This is your money. It's not my money. It's your money. Far too many people are arrogant online. They're always trying to sell something. I'm not interested in selling anything. I'm too old to be pitching deals or whatnot. I'm not selling you anything. What I want to do is teach a generation how to manage risk and actually pave their financial future. Develop something for those that they love the most. Their children, their families. Provide for their families. Maybe even provide for a better future for our country. It's time to have people invest in America. So, first of all, manage risk before risk manages you. Yeah, let's do that. Thank you very much, Kyle. It is time to get back to the steps of the Fed. It is time to, we're going to be doing a cross-country tour, that beautiful bride and I, and hopefully be able to shake hands with many of you along the way. But it's time for us to invest in the future. We are void of leaders who've sufficiently, and I'm using this in a broad brush, who have sufficiently invested in our future. Where is the infrastructure investment that should have occurred 20, 30, 40, 50 years ago? It's not there, and we just haven't done it. And so we are going to have to pick up the pieces and do it ourselves. So I want you to consider, as we go into the weekend, this final 40 minutes, manage risk. Well, where does risk really management start for you? First of all, we have to think of the individual positions. So look at your portfolio if you have an investment portfolio. If you do not at this time, this is not the time to race in. It's time to sit at the back with your cards, waiting for the right cards, waiting for the right cards to be dealt with. You've got the money, you wait on it. Whatever it is, you wait right now. But if you have it, look at your individual positions. And what I urge everyone is put in some sort of tool to safeguard you or eliminate some of that tail risk. One thing that I consider to be the easiest approach is for you to write in the money calls. Yes, it's going to strap you for the upside, but it's going to limit you for the downside. And for those who listen to me, say for instance, when FCX was at just around 54 and a half, $55, which is when we wrote 36 through $40 calls. 36, actually, most of them were 36 to 38. It was pretty good as it retraced all that way, and concluding going long $60 puts makes it very comfortable. So again, manage risk before risk management. In the next just under 40 minutes, 39 minutes left, consider where you write in the money calls. Now, one of the things that you can always do is you write a call in the money so that as you come out of the gate on Monday, there are no surprises. We can get a lot of surprises for the opening bell. You can easily take off, buy to close that in the money call if the stock goes up on Monday morning, or even if it goes down a little bit and you're comfortable. It is your choice. But the first thing that you have to do is always manage risk. You have insurance for your home. You have insurance for your car. You lock the car, your door when you go at night, when you go out to make sure your family is safe. Why aren't you doing the same thing for your investment portfolio? Why is our financial media not telling people to manage risk sufficiently? It should all be of risk management. It should all be of how to use options to mitigate risk. All of it, not this nonsense. We should not be buying into the hustle. Remember, roughly 20 years ago, a little bit more, when we went to decimalization of stock, and we eliminated open outcry, so guys like me who wanted to retire as floor traders couldn't. When we did that, we created a generation of gamblers. They don't realize that they're gamblers, but they're not investors. They're constantly flipping stocks as if we go up and down. Now, again, I repeat, the best investments are the ones that you never sell. Okay? So going into these final 38 minutes now, look at your individual portfolio and debate, do I want to write in the money calls? Now, for me, as an example, some of these positions I overwrite. I call it a ratio. I create a matrix, and it's a detailed calculation. We'll go over this again in a couple of weeks, where I write in the money calls, and I also write some way out of the money calls, knowing full well it will take a major move, and I can cover before then and still in a very profitable situation. But I always want to guarantee myself that cash flow, that writing calls and writing options, option theories that provides me, but it safeguards me. This is not the time to be writing puts. Let me tell you, this is not. This market is very prone to a very significant and a continued pullback, reversal, but none of this is unpredictable. The most predictable of things to suggest right now, and the financial media should have been saying this, is this market is prone, very prone. Jaws will collapse. And that's my point of why I suggested to call, why I wanted to call everyone today with a little bit of time on the clock. This market is prone. We have a recession coming. It's coming hot and heavy. Regardless of whom you vote for this coming November 5th, we have a recession coming. It's baked in. We were at a late stage economy before the start of the COVID years. This would push so much money, so much money was bloated, thrown out, and we will pay for that forever, certainly through my lifetime, and the youngest person here, your grandchildren, will be paying for that. We have a collapse of really a debt bomb that I believe, and I first started talking about this in 1986, I can't believe it. How would a 25-year-old talk about something like that? But a debt bomb coming in 2025 as my generation goes to retirement. The Fed right now is being pushed into a corner on a 50 basis point cut. I don't think they will do it in this coming September 18th release. I don't think they'll do it 25 basis, but that is the starter pistol for the market. Typically, historically will be the starter pistol for the market decline. That's what we're looking at. So we've got all these things colliding right now. Now's the time to be tactically solid. Now, this isn't meant to be a very dark story. It isn't. It really isn't, because there is enormous opportunities. I've said this countless times through my life and my career is there's more money to be made on a down market than an up market. An up market is tactically unsound, it's undisciplined, it's throwing money into the wind and it's just catching a little bit of a breeze. Fortune really falls your way and those kind of things. In this situation, this is highly detailed, disciplined, and programmable. In other words, it is a winning approach. And what you have to do is stay very structured, order, structure, and discipline. So this is going to be a very profitable, and it is a very, it should be one for very opportunistic for the disciplined trader who knows how to mitigate risk and use options to their full advantage. So points, again, the points I want to emphasize: this market is prone, but all of this is very predictable, and in actual fact what I have been predicting. So we have, again, now we've got 34 minutes left on the clock. If we'll talk about risk management more direct. If you have an individual portfolio or a portfolio with individual equities right now, consider writing your calls before this market close. Consider, and you have to make this decision, it's not mine, this is your money. Consider whether or not you want to write in the money calls right now and be a little more comfortable going into the weekend, because that is one thing I want to give everyone that I speak to. I want to teach you how to use options to have peace of mind portfolio insurance. Peace of mind is a beautiful thing. We do not emphasize that sufficiently in our world. You want to be comfortable. You want your investment portfolio to provide for you and your loved ones for not only your present life, but the many years thereafter, long after you are gone, okay? And build that family financial legacy. So I think that's about where I want to conclude, and I want to thank everyone for joining me as always. It really is a pleasure. It's going to be a lot of fun getting this going. I didn't have any intention of speaking today, but on camera. But you know what? I've got to get back in the swing of things. So if you don't mind if I do these sort of rehearsals, a week from now, no less than a week from now, we get on the road and we'll be motoring down the road. I'm not sure which direction we're going to go, because this is going to be America the Beautiful tour. We're going to go across the country from small towns, from sea to shining sea, shaking hands, seeing people, and experience, the country as I so love, and speaking with each one of you along the way. So we'll be back a little bit through next week, and then of course as we start our journey. Thank you again. I'm John Davies, and as always, I remind you: be the hunter, not the hunted. Thank you very much, everyone. Bye bye.